Welcome to the second video in the Asset Protection for Business Owners series, where we'll guide you through one of the most critical decisions for safeguarding your assets: choosing the right business entity. Selecting an appropriate legal structure can significantly impact your personal liability exposure, tax obligations, and overall asset protection strategy. In this video, we'll explore various business entities, including sole proprietorships, partnerships, limited liability companies, LLCs, and corporations. Understanding their benefits and limitations is crucial in finding the structure that best aligns with your business goals, provides optimal liability protection, and ensures a smooth path for future growth. We'll also cover essential factors to consider when making this decision, such as the level of personal liability protection, tax implications, and the ease of compliance. Whether you're starting a new business or reconsidering the structure of your current one, this video will provide you with the knowledge needed to make an informed choice and build a solid foundation for protecting your assets. Let's dive in. Business entity selection. Choosing the right legal structure for asset protection. Choosing the right legal structure for asset protection is a crucial decision for business owners to safeguard their assets from potential risks and liabilities. By selecting the appropriate legal structure, owners can minimize personal liability exposure and protect their business and personal assets from lawsuits, creditors, and other financial threats. Here are some key points to consider when choosing the right legal structure for asset protection. 1. Sole proprietorship. In a sole proprietorship, the business and the owner are considered one entity. While this structure is simple and easy to set up, it offers no protection for personal assets. Owners are personally liable for all business debts and legal liabilities, putting their personal savings, home, and other assets at risk. 2. Partnership. Similar to a sole proprietorship, partnerships do not provide asset protection for individual partners. Each partner is personally liable for the partnership's debts and legal obligations. Limited partnerships, LPs, and limited liability partnerships, LLPs, offer some degree of protection for limited partners, but general partners remain fully liable. 3. Limited liability company. An LLC is a popular choice for small business owners due to its flexibility and asset protection benefits. Owners of an LLC, members, enjoy limited personal liability for the debts and obligations of the business. This means that creditors typically cannot go after the personal assets of LLC members to satisfy business debts. 4. Corporation. A corporation is a separate legal entity from its owners, shareholders, providing strong asset protection benefits. Shareholders' personal assets are generally shielded from the corporation's debts and legal liabilities. However, forming and maintaining a corporation involves more administrative requirements and formalities compared to other legal structures. 5. S corporation versus C corporation. Both S corporations and C corporations offer liability protection for shareholders, but they differ in terms of taxation and ownership restrictions. S corporations are pass-through entities, where profits and losses are passed through to shareholders' individual tax returns. C corporations are subject to double taxation, with profits taxed at the corporate level and dividends taxed at the individual level. 6. Professional corporations, PCs, and limited liability partnerships, LLPs. Professional corporations, PCs, and limited liability partnerships, LLPs. Professionals such as doctors, lawyers, and accountants may opt for PCs or LLPs to protect personal assets from malpractice claims against individual partners. These structures provide liability protection for professional negligence claims while allowing professionals to share profits and management responsibilities. When choosing the right legal structure for asset protection, business owners should consider their specific needs, risk tolerance, tax implications, and long-term business goals. Consulting with legal and financial advisors can help owners navigate the complexities of different legal structures and make informed decisions to safeguard their assets effectively. Comparison of sole proprietorship, partnership, LLC, and corporation. Choosing the right business structure is a crucial decision for business owners as it impacts various aspects of their operations, liability exposure, tax obligations, and more. In this section, we will compare 4 common business structures: sole proprietorship, partnership, limited liability company, LLC, and corporation. 1. Sole proprietorship. A sole proprietorship is the simplest form of business entity, owned and operated by a single individual. The owner has complete control over the business and receives all profits but also bears all liabilities. Taxation is straightforward as the business income is reported on the owner's personal tax return. Sole proprietors have unlimited personal liability, meaning their personal assets are at risk to satisfy business debts and obligations. 2. Partnership. A partnership involves two or more individuals who share ownership and management responsibilities. There are two main types of partnerships: general partnerships, where all partners have equal management authority and share profits and losses, and limited partnerships, where there are general partners with unlimited liability and limited partners with liability limited to their investment. Partnerships are pass-through entities for tax purposes, meaning profits and losses pass through to the partner's personal tax returns. Partnerships offer shared decision-making and potential access to complementary skills and resources, but partners share in the liabilities of the business. Limited liability company, LLC. An LLC is a hybrid business structure that combines the limited liability protection of a corporation with the flexibility and tax advantages of a partnership. Owners of an LLC are called members, and they enjoy limited personal liability for the company's debts and obligations. LLCs can choose to be taxed as a partnership or a corporation, providing flexibility in tax planning. LLCs offer operational flexibility, simpler record-keeping requirements, and less formalities compared to corporations. 4. Corporation. A corporation is a separate legal entity from its owners, known as shareholders, who have limited liability for the company's debts. Corporations have a more complex structure with shareholders, directors, and officers, each with specific roles and responsibilities. Corporations offer the strongest liability protection for owners, as personal assets are generally shielded from business liabilities. Corporations are subject to double taxation, where profits are taxed at the corporate level and then again when distributed to shareholders as dividends. The choice of business structure depends on factors such as liability protection, taxation, management structure, and long-term goals. Business owners should carefully consider the advantages and disadvantages of each entity type to select the one that best aligns with their needs and objectives. Consulting with legal and financial professionals can help in making an informed decision tailored to the specific circumstances of the business. Benefits and limitations of each business entity. Choosing the right business entity is crucial for business owners, as it impacts various aspects of the business, including taxes, liability, management, and ease of operation. Here, we will discuss the benefits and limitations of different business entities commonly used by business owners. Sole proprietorship. Benefits: simple and easy to set up. Full control and decision-making authority. Direct flow-through of profits to the owner, avoiding double taxation. Minimal regulatory compliance requirements. Limitations: unlimited personal liability for business debts and obligations. Limited access to capital and funding. Lack of continuity in case of owner's death or incapacity. 2. Partnership. Benefits: shared decision-making and workload. Access to additional capital and resources from partners. Pass-through taxation, avoiding double taxation. Flexibility in profit-sharing arrangements. Limitations: unlimited personal liability for general partners. Potential conflicts among partners. Lack of continuity in case of partner withdrawal or death. 3. Limited liability company, LLC. Benefits: limited liability protection for owners, shielding personal assets. Flexible management structure. Pass-through taxation like a partnership. Less formalities and regulatory requirements compared to a corporation. Limitations: costs associated with formation and maintenance. Limited ability to raise capital through issuance of stock. C. Restrictions on ownership and transfer of membership interests. 4. Corporation. Benefits: limited liability protection for shareholders. Ability to raise capital by issuing stock. Perpetual existence independent of owner's status. Potential tax advantages such as deductions for employee benefits. Limitations: double taxation on corporate profits and dividends. Increased regulatory compliance requirements. Formalities in governance and record keeping. 5. S Corporation. Benefits: pass-through taxation similar to a partnership. Limited liability protection for shareholders. More flexibility in profit distribution compared to a traditional corporation. Avoidance of self-employment taxes on distributions. Limitations: restrictions on ownership, such as allowable number and types of shareholders. More formalities and administrative requirements than a partnership. Limited ability to retain earnings for growth and expansion. Each business entity type has its own set of benefits and limitations, and business owners must carefully consider their specific needs and goals before selecting the most suitable structure for their business. Consulting with legal and financial professionals is recommended to make an informed decision that aligns with the long-term objectives of the business. Factors to consider when selecting a business structure for asset protection. Selecting the right business structure is crucial for protecting your assets as a business owner. There are several factors to consider when choosing the most suitable business entity for asset protection. Here are some key considerations. 1. Liability protection. One of the primary reasons for choosing a specific business structure is to shield your personal assets from business liabilities. Select a business entity that offers limited liability protection, such as a corporation or a limited liability company, LLC. These structures can help protect your personal assets in case your business incurs debts or faces legal claims. 2. Tax implications. Different business structures have varying tax implications. Consider the tax advantages and disadvantages of each entity type, such as pass-through taxation for LLCs or potential double taxation for corporations. Consult with a tax professional to understand how each structure may impact your tax obligations and overall financial situation. 3. Ease of compliance. Ease of compliance. Some business structures require more administrative tasks and paperwork than others. Consider the level of compliance requirements associated with each entity type, and choose one that aligns with your capacity to fulfill these obligations. For instance, corporations typically have more stringent compliance requirements compared to sole proprietorships or partnerships. 4. Scalability and growth. If you plan to expand your business in the future, consider how easily you can scale your chosen business structure. Some entities may be more conducive to growth and expansion than others, so evaluate the flexibility of the structure in accommodating your long-term business goals. 5. Ownership and management structure. The ownership and management structure of your business can impact asset protection. For instance, in a partnership, each partner may be personally liable for the actions of the others. Consider the implications of shared ownership and management responsibilities on asset protection when selecting a business structure. 6. Industry regulations. Certain industries have specific regulations and requirements that may influence the choice of business structure. Ensure that the structure you select complies with industry-specific regulations and legal requirements to avoid potential liabilities and penalties. 7. Cost and administrative burden. Evaluate the initial setup costs, ongoing fees, and administrative burden associated with each business structure. Consider your budget and resources when selecting a structure to ensure that it is financially sustainable for your business. 8. Exit strategy. Think about your exit strategy and how easily you can transfer or sell your business with the chosen structure. Consider the implications of asset protection during the transition phase and choose a structure that aligns with your long-term exit goals. By carefully considering these factors when selecting a business structure for asset protection, you can better safeguard your personal assets and mitigate potential risks associated with your business operations. It is advisable to seek advice from legal and financial professionals to ensure that you make an informed decision tailored to your specific circumstances and goals. In conclusion, selecting the right business entity is a foundational step in your asset protection strategy. Whether it's a sole proprietorship, partnership, LLC, or corporation, each structure offers unique benefits and limitations that impact personal liability, taxation management, and growth potential. To recap, it's essential to consider factors such as liability protection, tax implications, regulatory compliance, and future business goals when choosing the best structure for your needs. By carefully evaluating these aspects, you can ensure that your business entity aligns with your long-term objectives while providing optimal protection for your assets. Remember, the choice of a business structure isn't set in stone. As your business evolves, periodically review your entity type to ensure it still meets your changing needs. Consulting with legal and financial professionals is always recommended to navigate these complex decisions. Thanks for joining us in this second part of the Asset Protection for Business Owners series. Stay tuned for the next video where we'll continue exploring strategies to safeguard your wealth and protect your business's future.